Thanks for joining, everyone. We will start up in about 1 minute. So if you need to grab that cup of coffee, get your napkin for your lunch, whatever that might be, go to the bathroom, go ahead and do that now, and we'll get started really soon. Thank you. All right, let's go ahead and get started. Thanks for joining, everyone, for another episode of our Camo Plans webinar. We're very excited to have Dallas and Josh here with us today. Before we get started, got to go over the disclosure so the lawyers don't get mad. Camo Plan does not provide investment advice or endorsements due to the nature of our industry. So today's presentation is going to be for educational purposes only. If you're going to make an investment, we always encourage you to talk to your CPA, realtor, attorney, whoever that professional is, to give you the right counsel for your investment and tax advice. And without further ado, I'm going to turn it over to Josh and Dallas. Let me stop sharing my screen. 1 second here. All right, you guys should have the ability to share.
Perfect. We good?
Looks good. Yep.
All righty. Well, Matt, thank you. On behalf of New Haven Marinas, excited to have an opportunity to educate your Camo Plan investors on what we believe is the most exciting real estate asset class that exists today. So a lot of people don't know about the marina space, so we look forward to educating everybody today, and certainly want to echo and encourage people, anyone that has questions. We have the Q&A opened. We want this to be engaging. We don't want to just be regurgitating information to everybody. We expect a lot of questions, and happy to answer those as we go along, and then we'll certainly reserve time at the end for additional questions and answers. So I'm Josh. This is my partner, Dallas. We're the founders of New Haven Marinas. As of today, I believe we're the only investment company in the space for the marina asset class, but it's not a new asset class. Marinas have been around for a very, very long time, dating back to thousands of years. There's always been boats, there's always been ships. It's just become more of an entertainment piece for America. But it's become a very strong and interesting asset class. And again, we'll get into that right now. So just again, a disclaimer from us. We're not giving investment advice, and past results are not indicative of future results. Just have to say that. But again, we believe if you talk with your professional advisors, whether they're tax, investment, or real estate, you'll quickly realize the benefits of investing in marinas.
We're just going to share with you why we like it.
Yeah, exactly.
And if you share that opinion, then great.
Dallas, I'll let you jump right in.
All right. So we first started, and I know Josh is sharing his screen with you right now, and you can read that. I'm not going to read it. But we first started looking into marinas, I guess 5 years ago, really. And at the time, my wife and I were empty nesters. We were living on our boat in Dallas, doing some traveling. I was chasing multifamily storage, the typical P type things, looking for, basically, we were out there doing what everybody else is doing, which is always trying to seek NOI. That's what we buy. And one day, my wife and I were walking down the dock, and I saw every single slip had a boat in it. And I know what I was paying for my slip, and therefore I know what everybody else is paying. And then the light bulb went off, and then that started this journey. The as Josh said, the marina space has been around for thousands of years. They used to call them harbors, and I don't know what they called them before then, but they've always been parking boats somewhere. The marina space is made up of 10,000 marinas in the United States, and 97% of them are owned by family owned mom and pop type operations. And eventually, in all of them, there comes a time where grandma or grandpa passes, they want to spend time with the grandchildren, whatever it is, and their kids and grandkids have already gone off and started their own careers. So there comes a time for a transfer, a transition. And that's where Josh and I realized we had a substantial opportunity because nobody else was chasing this market. So we're buying NOI. To put it in comparison, in here in Dallas, if I find a multifamily unit and it's got $1 million in NOI, I'm paying 20 million plus for it. A marina with the same $1 million NOI, I can buy it for 7 to 10 million.
And it's that margin that really started this journey for us. We can break down what we do and the advantages into really three main areas. To Dallas's first point, the low level of consolidation, the fact that the largest operator in our space, which is Safe Harbor, owns with the second largest operator, Suntex, less than 3% of the market share of marinas means the opportunities are out there for us in bountiful fashion. You combine that with Dallas's second point that we have very attractive cap rates. There's probably a lot of people on here that don't know what NOI is or cap rates. To make it as simple as possible, think of NOI as the cash profit after everything's said and done. And then cap rate is a way to determine how good of a deal you're getting. So if you buy that $1 million of NOI on a multifamily deal in Dallas for 20 million, 1 divided by 20 is 5%. So you bought it at a 5 cap. If you buy that same 1 million in the marina space for 10 million, 1 divided by 10, you bought it at a 10 cap or 10%. The higher the cap rate when you buy something, the better the deal, the bigger the margin. And when you sell, you hope that cap rate goes down. And so the third piece to what we're doing and why we love this investment class is the high barriers to entry. They're not building lakes on every corner in the city. By and large, they're not building more lakes in the United States. Lakes are heavily regulated and controlled by government entities, whether it's the Corps of Engineers, entities like the Tennessee Valley Authority. There are several agencies, but ultimately they control the waterway, they control the marina capacity, they control who can boat. And so what that means for you as an investor, when you invest in a marina, you have a very, very protected investment. I think we all, if we've invested in multifamily or storage long enough, know the story or the scenario where you buy a Class C or Class B property, hoping to get it up to a B or an A and increase rents. And then the 7-Eleven and dry cleaner shopping center next door gets torn down and they build a brand new Class A++ multifamily, and it totally throws off the rent expectations that you had for your property. That combined with rising interest rates have made lower margin deals a lot harder to be profitable. So we're in a space right now where our higher cap rates provide us a lot of margin to protect us from interest rates. They allow us the opportunity to enjoy the benefits of cap rate compression. Naturally, as more marinas get bought, cap rates will go down. So you buy it at a 10 and maybe you sell it at a 7. You combine that with increasing the NOI at a property, and you have a recipe for a very strong investment and return.
And Josh, I think that the marina story, largely to me, when I look at it in its most simplistic, I guess, landscape, is that it's a barrier to entry story that also, because of that barrier to entry, creates a supply demand story. I read a statistic recently that now this is more for the big boats, coastals. There's one slip for every 12 boats. And again, because that barrier to entry, meaning they're not making any more lakes and you can't buy and get a permit to build a new marina. Nobody's going to build a marina right across the street from you. Can't do it. Well, people continue to buy boats, but they don't continue to build new marinas. The supply demand story gets tighter and tighter, which translates ultimately into pricing power also.
So just a little bit more background on the marina market. Obviously, we just went through consolidation. Um, I think probably, and it piggybacks on the amount of people buying boats and nowhere to put them. 100 million plus Americans go to the lake every year. That's nearly 1/3 of the United States population goes to the lake every year. When you can, in one way or another, capture almost 1/3 of the United States population, there's a lot of upside. And we're not talking about low income. When you look at the boating market, over the last 30 years, there's been a major shift from sailboating to power boating. The two most popular boats on the market right now, number one is pontoon boats. It's the boats that are flat with a deck. They got the benches all around it.
Seat 13 people.
It's meant to go out and just hang out. And then the second most popular is the ski and the wake boating boats. Your average pontoon boat's about $80,000 brand new. Your average premium surf slash wake boat today, your Mastercrafts, Malibus, Nautiques of the world are $250,000 to $500,000. The price point alone means you're typically dealing with a higher net worth, higher income clientele. And that goes to the market size of the recreational boating industry and the fact that our profit margins for the industry at about 18%. So a lot of times we get asked, what's a marina? A marina is a very generic term. I think the simplest answer is it's a place to put your boat in the water, or to keep it right next to the water if it's dry storage. But we look at marinas like you look at doors on a multifamily or on a storage deal. Every slip that can house a boat in the water pays rent. That $250,000 boat is typically paying $400, $500 a month for their slip. They're on annual contracts, which means it's long-term rent or long-term revenue. And that's the primary function of the marina. But the marina is also a lot of other businesses. I like to talk about multifamily or storage. The purpose of those asset classes is it's a place to go at the end of the day and you're done. You're stopping at McDonald's, you're going to the grocery store, you're going to 7-Eleven to get fuel, you're buying beer at the 7-Eleven when you buy your fuel. And so other businesses are capturing your money before you get to the apartment or to your home. In the marina space, we capture your money the minute you get to the marina, whether it's at our restaurants, which are typically the heartbeat and the central focus of the marina. But we have fuel or we have a gas station. We have a convenience store. We sell beer, we sell chips, we sell ice. We also sell souvenirs and merchandise. Um, we have boat rentals. So maybe you don't have a boat at our marina, but you want to go out and enjoy the lake. You have to rent a boat. That's usually $400 or $500 for the day. You have repairs and maintenance. Think car dealership service. We can sell boats and we can service them. And then you have short-term rentals. We have 80-foot houseboats that you can rent for the week. We have cabins. We have campgrounds. The campgrounds afford the opportunity for short-term rentals for people to bring their RV and park overnight. And then we have many marinas where there's a significant long-term revenue component from the campground where people pay for annual sites because it's such a desirable location and make it their summer getaway. Maybe they live in Ohio and then instead of buying a home in Florida, they buy an RV and then they buy an RV site at our marina in Tennessee. So the big thing here is we have a significant long-term revenue component in this asset class, but you also have a lot of high cash flowing revenue centers that make up the entire marina business.
We have a little tiki hut that's probably 15 feet in diameter at one of our marinas, and it'll do 150,000 in sales in that little 15-foot tiki hut in 4 months.
It's right at the entrance of the restaurant.
Yeah.
And so you have to walk by it, and it requires a girl that makes, you know, $12, $13 an hour to sit in there and
Take credit cards.
take credit cards. But it's just an example. And typically on merchandise like that, you're making a 50% profit margin. So this isn't brain surgery. We didn't invent anything new. What we did is we found one of the last significant in size real estate asset classes that has not gone through a consolidation like storage, like multifamily, but take it a step further, like medical clinics, like senior living, like funeral homes, like dry cleaners. Um, this is a very large asset class that's by and large just beginning the consolidation wave, which means margins are always going to be the best when you're the first in. When you're the third or fourth investment group or corporation that comes in and buys something to squeeze the next, 5 cents to a penny out of the business, those margins are a lot smaller. It's what you're experiencing in storage and in multifamily. They've already gone through their consolidation 10, 20, 30 years ago. This is an opportunity to be a part of a brand new emerging asset class that, as of right now, no one's talking about but us.
The reason it's the biggest margin grab on the first wave of consolidation is once you think about when we come in and buy a marina from a family that's been doing it the same way for 50 years, their accounting department is based on sticky notes and butcher paper. And
The rent rolls on a dry erase
yes,
board.
yes. And so we come in and we clean them up, and I mean literally clean up grease that's been there for 50 years on the floors, clean them up, make them presentable. We go from sticky notes to modernized billing softwares. We just do the most basic things that anybody would know to do. Increase rent. Often these marine owners don't want to raise the rent on their friends, and they haven't raised rent in 10 years. And we bought our first two marinas. We bought, I guess, 3 years ago now. We increased NOI 36% in the first 12 months of operation, not by doing anything fancy. But my point is that when we've done all these things, I call them buy them, stabilize them, clean them up, institutionalize them with modern billing softwares. That's the biggest margin grab, because anybody that comes in after us in the next wave and the next wave and the next wave, uh, the biggest adjustments already been made. They can tweak here and there and come up with some creative ways, but the biggest grab is in the first wave of consolidation.
I'm gonna let you.
Oh yeah. This was you can see Center Bridge. So the marina space, when you were describing it earlier, this is such a great
Yeah.
way to express it. It is the intersection of storage, because you're storing a boat. That's what you're doing, and leisure and entertainment. And that's where the fun, the social, the spending comes in to this story. So I think I'd add this right here to it's a supply demand barrier to entry, and it's the intersection of two highest conviction themes in commercial real estate. That's
I always say, what better investment than to be able to go sit on a patio, watch the sunset, have a beverage, and just watch the energy and the vibe around you.
and the
'Cause
velocity of money.
that all
You see the
translates to
money
velocity of
spinning.
money. Everywhere you turn, people are pulling out a wallet and they're paying a transaction. And that all goes to the bottom line of the property. So, um, I want to touch on this for a second. We we have done three investment offerings, and we decided to implement the fund model because we are in such a emerging and exciting asset class that between that, interest rates, needing the ability to show banks you have ready capital, if we waited until we found a property to then announce it and build an investment package, we would miss out on a lot of the really good opportunities. And so we started a fund with very specific goals and parameters to allow us the ability to raise money, build capital, to put us in a position of strength when we talk with a mom and pa that own a marina, that we can execute on our strategy and deliver on our promises without waiting. And the fund model gives us that ability. But our fund is specifically designed to go after marinas in the lower United States. Doesn't mean we won't take an opportunity on the Great Lakes. At the end of the day, it comes down to NOI. But with the fund, the biggest thing to reward investors that invest early is your money begins accruing a pref the day you invest. And we set up 3 investment structures to reward those that bring a larger amount of money. And they're described here. We have an anchor class, a starboard class, and a marina class. And so it's pretty simple. Up to 250,000. It's a 65-35 sharing arrangement with an 8% preferred return. Our starboard class is 250 to 500,000 with a 70-30 sharing arrangement and a 9% return. And then the marina class is a 500,000 and greater investment. It's a 75-25 sharing arrangement and a 10% preferred return. A lot of you probably are familiar with preferred returns. It became popular over the last 5 years, but if you're not, what it means is it's a promise, if not a guarantee, that before we participate in any of the profit upside, you have had to have been paid 8%, 9%, 10% on your money before we have an opportunity to participate in a capital event. So there are no guarantees in the investment world, but this is sort of a guarantee that just tells you no matter what, you have to at least make that amount of on your money before we begin participating. And we're very proud that our investments have met our pref goals annually. We pay it quarterly. So if you're at the 8 number, you'd get 2% a quarter. Some quarters we pay a larger amount, and some quarters we pay a smaller amount, just because the one part of our business that is very different than most asset classes is the seasonality component. We bring in probably 60 to 70% of our revenue in a 3.5, 4 month span. It's the summer season. That's when people boat. That's when people spend money. So we have to make sure we are always good stewards of cash flow and make sure the business is profitable. So
Josh, I want to share our first fund. We opened it in December of 23. We closed it almost to the day, December 24. We successfully acquired 3 marinas, of which one of those potentially we may have an opportunity to exit it.
within about 18 months.
Mhm.
So there's a lot of excitement. We mentioned Safe Harbor at the beginning. Blackstone, the largest private equity group in the world, we're talking multiple trillions of dollars assets under management, bought or purchased Safe Harbor in April of this year. Um, when the largest private equity group buys the largest operator in your space, that makes a massive impact. The interest from the current players and the interest from players not in our space that want to get into our space has never been higher. There's a very common saying, follow the smart money. There's probably not smarter money than the largest private equity firm in the world. So we're constantly getting contacted about our portfolio, our marinas, and our willingness to sell. And so, we base our expectations on a 5-year hold, but that doesn't mean that a partial or a full sale couldn't happen sooner. So, the big part to our strategy, the first thing is go in, analyze the business, bring in 2025 technology and institutionalize the asset, provide organizational structure, systems, accountability. That drastically can improve your bottom line when you can go and actually see a snapshot of how your business is doing. When it's on post-it notes, your rent rolls on a dry erase board, leases are scattered across an office and they go back 10 years. you don't have a good grasp on how the health of your business is doing. So that's the first thing. The second thing is every marina that we buy, we make sure there is the ability to expand. In our industry, docks, slips where you park your boat, very minimal overhead. When someone ends a lease and a new lease begins, you can literally pull a boat out and move another boat in. There's no carpet needing to be installed. You don't have to paint. You don't have to fix fixtures. Very low maintenance on brand new slips. So they are almost 100% added value to your NOI, that cash profit at the end of the year. So we have a major emphasis on expansion. So it's two parts: institutionalize the operation and expand. You do that, you can increase NOI upwards of 50+% almost in the first couple years. You combine that again with cap rate compression, either just from the industry gaining value or the portfolio you grow building value. Private equity doesn't like to spend $4 million or $7 million at a time. They want to come in with 50, 100 million and buy multiples. And so the larger your portfolio, the more value, the better cap rate you'll receive when you sell.
I like to look at it as we're getting paid the biggest bulk of money for the grunt work. That's what we're doing. We're in the grunt grind business, going out and establishing relationships with these families, putting in the work. Again, literally cleaning them up, institutionalizing them, and we get paid handsomely to do the grunt work.
It's kind of like when people say, if I could just go from the infant period with the baby to when they're 18 years old and they're adults and they've got their intelligence and knowledge and feet underneath them. We're in the infant stage. We're up at 2 in the morning, at 6 in the morning, at all hours of the night.
Speak for yourself.
But it's a grind, and that's why I always say this isn't brain surgery. Um, but we're willing to do the work. And eventually there's going to be more of us. I'd argue 5 years from now, this will be one of the top seminars at every real estate investor conference there is. We're fortunate right now that not many people are talking about it because that provides us more opportunity. But there's 10,000 marinas in the United States and less than 400 are owned by the largest operators. So again, the market share allows us a lot of opportunity over the next few years. So um, I don't want to hit on too much. We recently got our first marina for the fund under contract. It's about a $6 million marina, but there is about $1.5 million of deferred maintenance that'll be required upfront to be approved to purchase the marina. And so we have a purchase agreement for 4 million, but the total value of the marina will be over 7 million, 8 to 8 million within the first 6 months of taking over. Because not only will we administer the deferred maintenance, but we'll also add slips, do the expansion. It's on Table Rock Lake. If you're not familiar, it's one of the prettiest lakes in the country. It's one of the most popular lakes in the United States. If you're familiar with Bass Pro Shops in Branson, Missouri, it's in the Branson area, just to the west. But it's one of the clearest lakes. You can scuba dive in the lake. So really pretty, really excited to begin a presence on this lake, and we look to purchase more marinas in the coming years in this area. I got our first question, so I want to go ahead and answer that from Donna. Thank you, Donna. She asked, what is the risk of marina and boat damage during storms? Our biggest expense at a marina is payroll. Our second biggest expense is insurance. Insurance is a major component of our analyze and our underwriting for each property. Oftentimes, family-owned businesses, I don't care what it is, are typically uninsured just because it's not affordable. And so we underwrite that. We make sure we underwrite it based on correct insurance coverage numbers. But ultimately, we have leveraged the power of our portfolio to get what's called a master policy. And so the more marinas we buy, the better rates we get across the board. And it happens instantly the minute we add the next property. For the first time ever, instead of going up 5 to 15% year over year, we saw our properties go down between 5 and 12%. So the master policy started this year. It's working. It gives us even better coverage than what we had previously. But ultimately, if a storm comes through and it makes, it damages it, typically we like to have good people on our maintenance staff that can make repairs and handle most of it in-house. But worst case scenario, you have to file the claim, pay the deductible, and get it fixed. So no different than owning any other real estate that gets damaged because of a tornado or a hailstorm, that kind of thing. So again, just want to go back over what we're doing. This is a $15 million proposed fund. So we look to raise about 15 million to acquire 2 to 3 assets. Um, we expect the timeline to be about a 5-year horizon. Our minimum is 50,000, and our minimum pref hurdle rate is 8% to our investors with quarterly distributions. Um,
Do we have another question here?
Another question. This one comes from Kenneth. What does the exit strategy look like for investors? The strategy is build a portfolio of marinas that attracts the attention of larger operators or private equity or institutional money. We have under pretty high confidence from an inside source at one of the largest operators that a portfolio of 10 marinas can captivate close to a 6 cap on the exit. So, currently we own 6 marinas. We'll own probably 9 marinas by the end of the year. And we're in super growth mode. So, we're going to continue to build a portfolio. But just as it happens, I mean, we purchased a marina in our fund last year in October, and within 2 weeks, we had a firm call us wanting to buy the property. So we know if we go in, institutionalize the assets, clean them up, and add value through expansion and other revenue centers, there's going to be a massive population of institutional dollars that want to buy our assets. So we put a 5-year horizon because you have to put a number on it. But I think we're pretty bullish, and it could be as soon as 2 to 3 years, there could be exit opportunities.
Kenneth, I think the answer to the question is because when we started this, it was a roll-up strategy. It was a 5 to 7 year roll-up strategy. We felt very confident about it. But then things started to change. Other people started to chase this space. And so to me, even though we put 5 to 7 year term, to me, we're going to have people interested in acquiring these marinas once we have done the grunt work, meaning clean them up, modernize them, institutionalize them is what I call it, and grow an NOI by adding the slip count. By the time we're done doing what we're doing, should be 12 to 18 months, we ought to be able to accomplish everything to where it's a turnkey asset. Once it's a turnkey asset, now it's not a 10 cap. You're selling it at a
7, 8.
6, 7,
Yeah.
8 cap, but you've grown the NOI. So I think as soon as you can get that process accomplished, which again, to me, 12 to 18 months should be sufficient for that, I think you've got an opportunity to sell at a pretty substantial upside.
And ultimately, just to put a final note on it, we have very, very good relationships in our industry, from dock builders to marina operators to marina owners to third-party vendors, including brokers
And government agencies.
government agencies. There's not a lot of brokerage firms that specialize in our space. There's probably 3 prominent ones. So they call us almost weekly with opportunities, and then also to inquire if we're willing to put our portfolio in a public offering or private offering. So the exit strategy for us is pretty simple. Go in, do the dirty work, add value, and the buyers will come. So
Can I ask just a quick question? This is me. I'm curious myself. When you talk about that 12 to 18 month period where you can institutionalize the property and specifically adding the additional slips, I know from this is coming from a kind of a lending background. Often an institutional lender will want to see 12 months of seasoning on a property or 6 months of seasoning on a property after the capex has been done. So does your 12 to 18 months where you see that sort of that hit of a bump in value, uh, does that include any kind of seasoning that a buyer would want to see, or is that kind of when the institutional phase happens,
Yeah.
including any kind of capex, and then any further seasoning then further seasoning after that would only increase the value?
We just bought a marina in
That's-
Kentucky. Is that what you were about
Yeah.
to say? We just bought a marina in Kentucky, and there's other marinas I can tell the exact same story. But we bought a marina in Kentucky. We built 60 slips. They filled instantly, and so that aging of a fine wine process that you're talking about, we added 60 slips, averaging probably $300 a month per slip or close to it, and they were filled
Immediately.
like literally in 24, 48 hours because people saw that we were building them. The marina was 100% occupied, had a very lengthy waiting list. So there were people racing to
The
get
first
their boat parked in there.
The first 40 were announced on a Facebook post, and 100% of them were signed leases before the end of the week, and the slips hadn't even been floated out yet. Uh,
Wow.
it goes to the supply and demand story.
Yep.
Not every marina has that strong of a supply or demand story, but it's very similar. And sometimes we have the ability to add a lot of slips. We're not going to shy away from a marina where there's the ability to add 200 slips. And we don't have a 5-year development plan. When we go in, we do it and we do it fast. And so if that was ever to happen, no, we wouldn't get a credit for 100% occupancy necessarily in income or seasoning. But we also would tell any prospective buyer we have no interest in selling unless you give us 12-month forward looking benefit. And in our industry, that's pretty standard. Just because, again, the margins, the expectations, supply and demand, you can demand that if you have a track record, which we have. So,
Awesome.
Scott had a question. Do you focus on freshwater more than coastal? That's a great question. Usually we bring that up. Um, it comes down to margin. We are chasing margin. That's the simplest approach to what we're doing. And think of real estate. You can buy a 2,500 square foot house in Waco, Texas. That same house in Dallas could be 3 times more expensive. And your rent isn't necessarily going to match or mirror that same ratio. In the marina business, oftentimes coastal marinas are purchased at a 5 to a 6 cap because they're more desirable. Less of them are family owned anymore. That is where the largest operators in our space have focused for the last 5 years. We like the inland lakes. We like the environment. We're not opposed to coastal, but it comes down to margin. And if the right deal is presented to us, we will absolutely jump on it. But right now, our portfolio is 100% inland. And right now, I think we only have a couple coastal on our radar that we're looking at. Most of them are freshwater.
I don't like salt. I don't like hurricanes. And I don't like bidding on a marina that has 50 other companies uh,
Bidding.
bidding on it against me.
I also don't like sharks.
I don't like sharks.
uh, Anonymous asked a question. Whoever you are, thank you for your question. Are there depreciation benefits available to investors that can provide tax incentives? Absolutely. The right property with the right approach, we can do a cost segregation study. We did a property last year on Lake of the Ozarks. And uh, oh gosh, I'm blanking on the dollar amount, but it was a massive depreciation benefit. We did accelerated depreciation on the parts of the whole, and it was very beneficial for our investors. Sometimes it doesn't make sense to do it that way, and we've used straight line depreciation, but there's definitely depreciation benefits with our asset classes, no different than multifamily storage or any other real estate class. So thank you for that question. We talked a little bit. So this is our third offering. Our first offering wasn't technically a fund, but it was two properties. So it was, to me, more similar to a fund. But they are sister properties within about 5 miles of each other by the same owner. To date, in the 2.5, almost 3 years we've owned it, $5 million raised. We're current on distributions, and we've paid over 1.1 million in pref distributions to our partners. We purchased those assets for about $16 million. Today, they're valued probably close to 22 to 24 million. And that's again in less than 3 years. We've increased the value by about 50%. Our second offering started in the end of 2023, closed in December of 2024. We raised just over 7 million. We just finalized the last property in that portfolio. But that fund owns a marina in Tennessee, a marina on Lake of the Ozarks in Missouri, and a marina in central Kentucky. So the total asset value currently is north of 34 million. And we just started our distributions this year on time. So very proud of that as well. So with that, just want to open it up to additional questions. Eric, you asked, how soon are you able to cash flow the property, day one or after executing the business plan? Typically they can cash flow almost immediately, but we do a 6-month hold back on distributions to make sure we have time to stabilize the business, find the cobwebs, and really build up cash flow and reserves for the seasonality component of the business. Um, you can get in a bad way quickly if you look at your cash flow in July and expect it to be the same in February. And so for that reason, we want to make sure we have adequate reserves and always put an emphasis on the cash flows and the strength of the business before we look at doing distributions to our partners. So we are open that we do a 6-month hold before we begin our first distribution. We don't have any other questions at the moment, but I always like to add, if you have questions, please let Matt know. Matt has an open line with us. And then we also have our own portal on our website, newhavenmarinas.com. On there, you can click to receive more information. We always ask when you're on there and you fill out the how did you hear about us, that you make sure to put other and then put in Cama Plan so we know, where you came from. We know what you may have heard and can have a stronger conversation more quickly. But please visit us at newhavenmarinas.com. You can see our portfolio. You can find out ways to invest and other information on our website.
And we did get one more question from someone. They just wanted you to repeat what the minimum investment was.
50,000 is the minimum investment. And I do believe, Matt, you're going to be sharing a recording of this webinar.
Yes. Awesome. Well, this is terrific. One more question that I did have is when you're looking at the exit strategy, is the exit's obviously a sale of the property. Is that to an institution like Safe Harbor, or is there like a kind of like a more middle market institution that you're typically selling to, who then sells it off to Safe Harbor?
There is, I mean, Blackstone's the largest private equity group in the world. And when the largest private equity group in the world, and some would argue the smartest money in the world, makes a move like this, it gets the smaller guys' attention. So I would say, Josh, you and I receive phone calls on a quite regular
Yeah, probably
basis
weekly at this point.
from small to mid-sized PE firms.
But we've also had interest from the largest. And again, I mean, there's groups out there that have 3 marinas, there's groups out there that have 10, and there's groups out there that have 100 plus. And really, that's Safe Harbor and Suntex. Most operators have between 5 and 15. We'll probably be the top four, certainly one of the top five operators within the next 18 months, just with our growth trajectory. And so we're going to be that mid-sized group. But the thing about what we're doing, different marinas and properties have different value proponents. They have different upside. The story's different, the region's different. And so sometimes you'll have somebody that's just interested in one of your marinas. That doesn't mean we take less value in a transaction because we make it very clear up front, hey, we'll have the conversation, but we're starting here. And if you're not
Sure.
interested, that's fine because we're going to package it later. But there's certainly power in numbers. And there's a lot of institutional money that, I mean, is 200 million, and there's a lot of institutional money that's 20 billion plus that's out there that's circling like sharks, no pun intended, to look at how they can get into the space. And they're more likely to get into the space with smaller groups that they can buy 100% of the portfolio to have a big, strong starting presence. So again, I think the opportunity is that's what's exciting. There's plenty of people out there and firms and institutional money that are going to be willing to purchase when we're ready.
That's awesome. This was a great presentation. I definitely learned something new, and I think I can speak for everyone on the most people on the call that this was a whole new asset class to learn about. So thanks very much to both of you. If you want to reach out to Josh and Dallas, please use the contact information there in front of you. You can always reach out to Camaplan and we'll make sure we send you in the right direction. Thanks a lot, guys, for your time, and thanks for everyone on the call to be here today and learn about marinas.
Absolutely. And if we could just add with one final challenge, um, the key to any strong investment portfolio, no matter if you're worth 100,000 or a billion, is diversity. And we're not asking anyone to ever give us 100% of their net worth, but we will challenge you to maybe step out of your comfort zone and be open-minded to what other opportunities are out there. But don't miss out on being at the beginning of a consolidation wave. Because 5, 10 years from now, you're gonna see marinas performing and say, man, I had an opportunity. If we could all go back and invest in Amazon or Apple in the late 90s, we wouldn't hesitate today. This is an opportunity to be a part of something at the beginning. And so not asking for 100% of what you have, but to spin off a little bit of your portfolio and get exposure to the marinas, we think would be a win-win.
Awesome. That's a good challenge. Thanks again, Josh and Dallas, and thanks everyone for joining today. We'll see you guys next week on the next one.
Thank you for having us,
Awesome.
Matt.
Thank you for having us. This is
Have bye.